In today's video, I'm going to show you a powerful strategy that's going to make you want to kiss real estate goodbye. For whatever reason, we all seem to have a better grasp on real estate than we do on the stock market. It's probably because a lot of us own a house. Everyone can easily understand the concept of buying a house as a long-term investment and then making monthly income by renting the house out to someone. Well, today I'm going to show you a stock strategy that's going to make you rethink messing with all the hassles of real estate. It's one of my favorite plays, and it's called writing covered calls. We talked about this in a recent video, but today I'm going to show you how to supercharge this strategy. We'll do this by entering the play with a leap option instead of purchasing the stock. This gives you so much more leverage, and you'll see what I mean as we go through the play. But here are two reasons I think this play beats the real estate model every time. The classic real estate model is you buy a house as a long-term investment and you rent it out for monthly income. And eventually you sell the house for a profit. Sounds good, right? Well, maybe not. First, think of the time it takes to find the best house to buy in a real estate investment. You got to drive around, you're looking at several houses, you're putting in a bid, someone beats you on the bid. All of these things are happening. Then most of the time you've got to fix it up. So this could be another time-consuming thing or expensive to find a good contractor to fix it up for you. Second, once you've got the house ready for a renter, you're only going to collect rent once a month, and that's at a fixed rate for at least a year. And you say, what do you mean by that? Well, why is that a problem? That sounds great, collecting rent every month. Well, when you write covered calls, you can collect the rent twice a month. But on top of all that, guess what happens when something goes wrong with the house, like a major plumbing issue or a leaky roof or a broken window? You have to deal with all that. There is a better way to have an investment like this, and it doesn't have to involve any of the things that I just mentioned. It's by writing covered calls in the stock market. Just like the real estate example, you buy a stock and you hold it for a long period of time. That's your investment, just like buying the house. Then as the stock rolls up and down, you write covered calls each time the stock dips down, and that's your income, just like rent money. The amazing thing about writing covered calls is that you very often write the covered call twice a month, meaning you're bringing in income twice a month instead of just once a month. Okay, let's get into the strategy. So the play itself is going to be very similar to the last time we went over this strategy, except this time we're going to supercharge it by purchasing a leap option rather than buying the stock. A leap option is just a fancy Wall Street term for a long-term option. The cool thing about it is this way we can control a lot more shares. Now we have to remember this is an academic example because this took place in the past, but it's a real stock and you could have done this exact play. The overview of how this play works is you'll purchase a leap option, then you'll hold that as if you're holding the stock. And we're going to do this probably less than 6 months, but every single month we're going to write covered calls every time the stock dips. Usually that's twice a month. So each time the stock takes a dip, you're going to write a covered call, and that will bring in some income for you and your family. So we've got a stock called MITK, and we're going to enter the play on March 25th, 2021 in this academic example. Now remember, this stock may not be any good for now, but it was great back then. And guess what? You don't have to drive all over town looking for houses. Okay, now to make this thing really pop, you got to remember this. The last time we did this example, we made a total profit of $9,430. Keep that in mind. Let's take a look at what it looks like though if we do this with leaps. So with leaps, instead of paying $13.62 per share for the stock, we're going to pay $3.58 per share to control the stock. So now, instead of controlling only 1,000 shares, we're controlling 3,500 shares for the same money, the same initial investment. So now I'm going to show you the money. Now remember, the first time we wrote calls last time, we made $550 profit. When we simply do the same play, but we switch to leaps rather than buying the stock, we buy the long-term leap, which is a long-term call option. Now, instead of $550, that first call writing event, we make $2,100. And we're going to be doing that at roughly twice a month. So the next one, instead of making $600, we made $2,275. The next one, instead of making $650, we made $2,450. So then on the next roll, instead of $850, we make $3,150. Now on that last roll, it didn't work that great. We made about $100. But with the leaps, we made $350. All right, so now when we go out to August the 2nd, we're going to sell the stock. Now remember, it was $13.62 a share when we bought it, and now it's $20.32 per share. With Leaps, remember the cost of the play is the same. It was $13,620, but because we control so many more shares, when we sell that at $20.32 per share, we put $71,120 in the bank. So the difference between $13,620 and $71,120 is $57,500 on the sale of the stock. Now, wait a minute, though. We made money every month, didn't we? A couple of times every month. So when you add down that column, we made $10,325 on the call writing. So you add those two together, it's a profit of $67,825. Now, you're talking about showing the money. Last time we made $9,430. This time we make $67,825. Last time we made 68.5% return. This time we make a 498% return. And remember, that only took 4 months. What if you annualize that? 2,448% return. Wow. I mean, so we have really magnified the earnings for our family by just switching to Leaps. Now, this whole thing took 4 months. We bought a 6-month Leap. We were able to grab that for $3.50 per share rather than having to pay the $13.62 per share for the stock. That's where the leverage came from. For the same money, same initial investment, same risk, if you want to put it that way. So guys, we're about out of time. If you love this video today, check out the links in the description below. We'll see you next time.